Hello, in this video we will learn about financial education in every person's life. So let's start. So there are multiple chapters here. There are a total of 15 chapters. So first one is introduction. Chapter number 2 is key concept in personal finance. Then we have financial planning. Chapter 4 is savings related products. Chapter 5 is investment in securities market. Chapter 6 is insurance related products. Chapter 7 is pension, retirement, and estate planning. Chapter 8 is borrowing related products. Chapter 9 is government schemes for various savings and investment options. Chapter 10 is tax saving options. Chapter 11 is caution against Ponzi schemes and unregistered investment advisors. Chapter 12 is grievance redressal mechanism. Chapter 13 is grievance redressal agencies. So let's start with the chapter first, that is introduction. So financial literacy assumes much significance in today's world. Financial literacy as a life skill is to be imparted to every individual for management of their personal finances. People face various issues like complexity of financial products, prevalence of fraudulent and Ponzi schemes, need for funds to get a better quality of life after retirement, etc. These issues have generated need for a better management of personal finances with proper management of income and expenditure. Financial education helps people in being financially literate and develop a positive attitude towards managing their income, expenditure, assets, and liabilities properly, which would lead them to a situation of better financial well-being. Financial planning is a must for every household. Financial planning goes beyond savings. It is an investment with a purpose. It is a plan to save and spend future income and should be carefully budgeted. This literature provides a fair understanding of the personal finance world, explaining the concept of financial planning, key concepts in financial literacy, various investment options, savings and investment products, insurance and pension products, retirement planning, caution against Ponzi schemes, tax saving options, investor protection measures, do's and don'ts of investing, etc. This booklet is meant for the general investors, and at the end of completion of this module, it is expected that the target participants will get better understanding and better management of their personal finances to achieve better financial well-being. Chapter number 2, Key Concepts in Personal Finance. Some important concepts in personal finance which an individual should be aware of while managing their personal finances are mentioned as below. What are savings? Savings are the surplus of income over expenditure. Of A is income, money earned from various sources like salary, wages, etc. And the second one is expenditure, money spent on various items which include essential and non-essential items. People usually meet their short-term goals and savings. Money in savings account of a bank earns a small amount of interest and it is easy to withdraw it whenever needed. People can save in savings bank account, post office savings accounts, etc. What are investments? Investment is the act of deployment of money out of savings into financial or non-financial products with the expectation of earning higher returns over a period of time. The various products in which investment may be done are financial products, these fixed deposit in a bank, buying shares in stock market, investing in mutual funds, etc. And non-financial products like purchase of land, gold, silver, etc. The investments may be done for short term, medium term, and long term. While investing, One should always remember that the return on investments may rise or fall over time, and it is quite normal that to happen. Difference between savings and investment is mentioned in the table below. So, savings in bank account, and the second part is investment in fixed deposit and other financial products. So, the meaning of savings in bank account is a portion of one's income which is not used for expenses. And investment is putting your money in various investment products to make money grow. What is the purpose of savings in a bank account? The purpose is savings are made to maintain liquidity to meet short-term or urgent requirements. The purpose of investment is investment are made to make money grow by creating assets that can generate income in the future or increase value of assets. What is the risk? It is low or negligible in savings, and it depends upon the asset in which investment is done. What is the liquidity? It is highly liquid. The savings in the bank account are highly liquid, and the investments are comparatively less liquid. What is the importance of savings and investment? Investing money makes it grow for you. Any increase in the value of the investment over a period of time uh, or investment returns that you receive gets you so much closer to your financial goals. One should start saving and investing early in his or her life. The earlier you start, the better you will be placed in meeting your goals like owning a house, financing your child's education, funding for your retirement, etc. What are assets and liabilities? Items that you own and have economic value are your assets, and items which you owe to others or have borrowed from others are your liabilities. For example, if you save and then invest in a fixed deposit, it is your asset. On the other hand, if you borrow funds, take a loan from a bank or any individual, it's your liability. What is debt? Money borrowed to meet shortfall of money when expenses are more than funds available in hand is called debt. What is the time value of money? As time passes, you will realize that if 10 years back you could afford to purchase a full lunch for a particular amount of money, then today you could only afford to get only a portion of the lunch in that amount of money. This means that the value of a 500 rupee note would be higher today than after 5 years. Although the note is the same, you can do much more with the money if you have it now because over a period you can make the money grow by earning interest on the money. By receiving 500 rupees today, you can increase the future amount of your money by investing in gaining interest or capital appreciation over a period of time. At the most basic level, the time value of money shows that time literally is money. That is the value of the money you have now is is not as the same as it will be in future and vice versa. What is inflation and effect on investments? Inflation refers to rise in prices of goods and services over a period of time. As the cost of goods and services increases, the ability of a unit of money, say 1 rupee, to buy goods and services keeps declining. In other words, the purchasing power of money, that is, ability of money to buy anything, decreases. It is important to take into account the effects of inflation on your investments during financial planning. Investors greatly fear inflation since it reduces the value of their investment. How does inflation affect my investment decision? A vada pav costing 2 rupees 5 years ago would now cost 7 rupees. Thus, this increase in the price is not as a result of higher quantity or a better quality of the vada pav, but due to inflation impacting the prices of the ingredients and finally the end product. What are the steps that you can take to avoid the adverse effect of inflation? Try to determine your real rate of return, or the return you can expect after factoring in the effects of inflation. To reduce the risk of decrease in the value of the money, you can invest the money available to you today at a rate equal to higher than the rate of inflation. What is power of compounding? With simple interest, you can earn interest only on the principal, that is the amount you initially invested. While with compounding interest, you can earn interest on the principal as well as the previously earned interest. Let us understand the magic of compounding with the help of example. So here we have year 1, 2, 3, 10, 20, and 40. And here we have the principal, then rate of return, the return earned, and the maturity value. So if 1,000 rupees invested today at the rate of 9%, the return would be 90 rupees and the maturity value would be 1,000. In the second year, the interest would be earned on 1,090 instead of 1,000 rupees. So 9% of 1,090 is actually 98, and after adding 98 to the 1,019, the maturity value is 1,188. Then in the third year, we have 1,188, and we will get 9% on top of it. The return is 295. The maturity value is 1,295. Then it will go on, and in the year 40, this amount would become 28,816, and the maturity value will become 31,400. So the 1,000 rupees that a person has invested in the first year will become 31,409. That is 30 times in 40 years. So the principal amount is changing at the end of every year on account of addition of return earned for that year to the principal. As principal is increasing every year, the return earned on interest principal also is increasing. The above example shows how an initial investment of 1,000 rupees grows to 31,409 over a period of 40 years. When the return is reinvested, you earn a return on the previously earned return, and so on. Whereas case of simple interest, the principal amount remains at 1,000 rupees only for all the 40 years, and with annual interest of 90, the amount grows to only 4,600. So the principal plus return from the first year collectively becomes the principal for the second year. And principal plus return from the second year collectively becomes the principal for the third year and so on. The rule of 72. Mathematicians say that you can find out how long it will take you to double your money by simply by dividing the number 72 by the interest rate. So let's say your parents give you 200 rupees for your birthday and you plan to invest it. If you put the money into an account that earns 6% interest a year, how long will it take to grow 400 rupees? So we will divide 72 by 6%, that is 12 years. So in 12 years, your money will have doubled to 400 rupees. Rupee cost averaging. Rupee cost averaging is the process in which we invest a fixed amount of money at regular intervals irrespective of the market fluctuations. For example, you buy more units when unit prices are low and less unit when unit prices are high. By investing according to the schedule, you avoid the complex or even impossible duty of trying to figure out the exact best time to invest. The rupee cost averaging that averages out the cost of your units and hence lessens the impact of short-term market fluctuations on your investments. For example, look at the table. So in January month, we paid 2,000 rupees. The cost of per unit is 50 rupees only. So the number of units that a person can buy is 40. In February month, the cost per unit becomes lower, that is 41.67 per unit. So we will buy more units in that time. In March month, with only 2000 rupees, the cost per unit becomes 47.62 and we are only able to buy 42 units only. In April month, with 2000 rupees, the cost per unit is 58.82 and we are able to buy 34 units this time. In May month, we are able to buy 28 units when the price is 71.42 rupees per unit. In June month, we are able to buy 30 units only because the price is becoming higher, 66.67. And in July month, we are able to buy only 50 units. The same goes for August month. The price is becoming higher, so we are able to buy less units. And at the end of it, in the in a financial year, in a calendar year, the total investment is 24,000 and we are able to buy 466 units. From the above, it can be seen that the total investment of 24,000 over a period of 12 months, an investor received 466 months of mutual funds. The average price per unit comes to 51.50. Chapter 3, Financial Planning. Financial planning is the process of estimating financial needs of a person and implementing a comprehensive plan to meet those financial needs during his or her lifetime through investments. For example, birth of a child, education, purchasing house, marriage, meeting emergency situations like an illness, to meet the impact of an accident, death, or natural calamities like flood, etc. B. The financial planning process. The financial planning process starts from the determine current financial position, then identify and set your financial goals, then identify suitable investment venues, then we have to evaluate alternatives and strategize, then you have to create and implement your financial action plan and review and revise the financial plan. So this is the financial planning process. Determine your current financial situation. If you want to plan for the future, you need to understand your current financial position. You need to understand what your incomes, expenses, assets and liabilities and debts are. Your net worth is simply assets you own minus liabilities you owe. The net worth is calculated as under. So on the left side we have assets and on the right side we have liabilities. So example of assets are car, bank balance, house and total assets. So let's say a car is worth 25,000 rupees. We have a bank balance of 5 lakhs. We have a house of 50 lakhs. So the total asset is 55 lakh 25,000. On the right side, we have the liabilities. So we have a house loan on the house that we own. And the house loan is of 20 lakhs. The car loan we have 10,000 rupees. So the total liability is 20 lakh 10,000. So the net worth is asset minus liability. That is equal to 35 lakhs 15,000 rupees. Your net worth indicates your capacity to achieve your financial goals, such as buying a home, paying for university education, future medical expenses, repayment of loan, etc. Develop financial goals. Your financial goals can range from acquiring assets, saving for emergency, as well as making investment for your future financial security. The financial goals of an individual can be categorized as below. First one is basic financial goals, that is food, clothing, shelter, etc. Second one is secondary or advanced financial goals like education, house and marriage. Then we have retirement planning. After that we can plan to build an estate. Individuals can use a variety of investment, risk management, and tax planning strategies to meet their financial goals. These goals change over an individual lifetime, and accordingly, the financial plan should be reviewed on a regular basis for any modification as per changing the circumstances. While making financial plans, one should first ensure a planned savings amount and then plan for meeting expenses. Mr. Warren Buffett, one of the world's most successful investors, has said, "Don't save what is left after spending, spend what is left after saving." Therefore, the basic concept that everyone should focus upon while utilizing his income is as follows: income minus saving equals to expenditure. Wealth is not built overnight. One needs to set specific financial goals. A good financial goal should be SMART, that is specific, measurable, achievable, realistic, and time bound. So, what is the definition of specific? So, you need to know exactly what you want to achieve and when you want it. The incorrect approach is I need to set aside money for my granddaughter's birthday next year. So, this is an active approach. The right approach is I need to set aside 10,000 rupees for my granddaughter's birthday next year. Measurable. A goal should be measurable so you know when you will achieve it. Incorrect approach is I will pay off most of my credit card dues soon. Right approach is in the next 6 months I will pay off all my credit card bills in full. Achievable. Your goal should be within a reasonable reach. The incorrect approach is I will save money. The correct approach is I will save 48,000 rupees every year by setting aside 4,000 rupees every month. Realistic. The definition is your goals to be based on resources and tasks that you can reasonably achieve. The incorrect approach is by saving regularly, I will become a millionaire. The correct approach is by saving regularly, I will be debt free by January next year. If I continue saving regularly after clearing all my debt, by next December I will be saving the sufficient amount to fund 6 months of my living expenses. Then we have time bound. The definition is goals with timelines allows you to track your progress and encourage you to keep going until you reach your goal. The incorrect approach is I will save money for my daughter's marriage. The correct approach is I will save 50,000 rupees every year for the next 10 years for my daughter's marriage. Goal based investing focuses on meeting goals that are personal and specific. The focus of this approach is to arrive at future value of different goals and then pursuing these goals through asset allocation made for investments according to each individual financial goal. To adopt this strategy while investing, one must plan as per one's age, risk appetite, ability to take risk, financial situation, and investment horizon. Five-step approach to achieve financial goals. Step 1. Identify specific financial goals. It is important to prepare a proper plan to fix each investment with a specific goal. It is very important to identify one's financial goals and aspirations and estimate the amount of money it will be needed to fulfill them. Step 2. Classify goals into short-term, medium-term, and long-term. Short-term goals are typically financial requirements that are expected to arise in time period ranging from a few months to 1 year. Medium-term goals may have a time horizon of 1 year to 8 years. Goals like buying a property, starting your own venture, getting enrolled in a professional course, etc. can be medium-term financial goals. Long-term goals may have a time horizon of 8 years or more. For example, child's marriage, retirement planning, etc. Step 3. Decide upon asset allocation. Asset allocation is a strategy for investing your money into various asset classes such as equity and debt that would suit an investor's income and risk appetite. Asset classes may be referred to groups of financial instruments which have similar financial characteristics. Asset allocation refers to an investment strategy that aims to balance risk and reward in the form of returns. By dividing the asset of an individual's portfolio according to his or her financial goals, risk tolerance, and investment horizon. Asset allocation. Asset allocate assets depending on your age, lifestyle, family commitments, and your financial goals. While allocating your funds, distribute investment across various asset classes such as equity, bonds, real estate, etc. to benefit from diversification, which helps reduce risk and increases the possibility of earning moderate to high returns on your investment. For example, an individual's portfolio when he or she invests in various asset classes, depending upon his financial goals, risk appetite, investment horizon, etc., may look like any one of the following. So, first example is total portfolio where we have 70% is equity, 15% of debt, and 15% of gold. In the second example, we have 40% of equity, 50% of debt, and 10% of gold. In the last example, we have 60% of equity, 25% of debt, and 15% of gold. Choose the right investments with diversification within asset classes. Arriving at the right risk return combination and choosing the right asset allocation can seem difficult. For a longer term goal, it is advisable to focus on maximizing returns with diversified asset allocation. Diversification. It refers to the process which reduces risk by making investment into various financial instruments, industries, and other categories. It aims to minimize loss on return by investing in different asset classes: debt, equity, gold, real estate, etc., that would react differently to the same event, such as those relating to the economy or markets. Although diversification does not provide guarantee returns guarantee against loss, it is the most important component for reaching long-term financial goals while minimizing risk. Uh, we have one tip also. So don't put all eggs in one basket. That means we should not invest all of our money into one asset class. Diversification is doing investment in various financial instruments or asset classes, and the goal is to find an appropriate balance between risk and return. Step 5 is review and revise financial plans. To stay on track, regularly review the progress towards your goals and achievements. Review your investments like stocks and mutual funds in your portfolio. Certain products may seem tailor-made for specific needs, but they may not be actually useful for one's portfolio. Be aware of such investment options. C. Choosing investment options and understanding risk. The investment products available for an investor are fixed income securities, equity investments, mutual funds, etc. Every asset class has its own risk and return. Investment in equities are considered as high risk investment as their returns are subject to performance of individual companies and general economic scenario. On the other hand, investments in the debt instruments considered having relatively low risk. For instance, government bonds are considered to be effectively risk-free due to the trust that government will not default on the repayment to investors. Three pillars of investment. The investment decision of an individual is influenced by safety, liquidity, and return. These are called three pillars of investment. Safety. This is about how well protected the principal and return on the investment is. For instance, if you lend 100 rupees to someone, will it be repaid in time, or is your capital of 100 rupees safe? Safety means your money invested is protected, and there is every possibility that on agreed date or maybe even before it would be returned whenever needed. Liquidity. This pillar of investment is the degree of ease with which you can encash or liquidate your investment at fair value. In the above example, it will be about how soon will you get your money back if you need it immediately. Return. What is the return you will get on your investment? It could be in the form of income, appreciation of capital invested, or both. Income means an investment's earning in the form of interest or dividend payment. Capital appreciation means the increase in market value of investment over a period of time. For example, if the present market value is higher than the value at the time of the investment, it is called appreciation or gain. In case the market value is lower than the value at the time of investment, it is called depreciation or loss. Returns on investment. Returns from investment can be described as money made by an investor on his or her investment. The returns can be in two ways as explained below. Regular income. So there are two types of regular income. One is equity investment and second one is fixed income instrument. You get dividend when you buy and hold equity shares of a company and units of equity mutual fund. Fixed income investment. In debt securities, you receive fixed interest on interest-bearing investment. Capital appreciation. When the value of initial investment increases over a period of time and the investor benefits by selling part or whole of the investment at the increased value, it is called capital appreciation. Example of capital appreciation. An investor bought 100 shares of company XYZ Limited at 50 rupees per share by paying 5,000 in total. When the value of the XYZ share increases to 65 rupees per share and the investor sells 100 shares in the market, he or she will get 6,500, that is 100 shares at the rate of 65 rupees per share. The investor stands to gain 1,500 rupees from the initial investment that he has made. This is called capital appreciation or capital gain. What is risk and returns? Risk can be defined as the probability or likelihood of a loss occurring in relation to your expected returns from any particular investment. It is a measure of the level of uncertainty of achieving the returns as per expectations. Risk versus return. No such thing as risk-free investment. Risk and return relationship is a trade-off. Risk cannot be eliminated but managed. Manage your risk through diversification. So risk and invested go hand in hand. The good news is that risk comes with the potential for rewards from investing, which is what makes the whole process worthwhile. This is the this is the pattern of risk and return. So when we have low risk, then we have low return also. But whenever we want higher risk, then we have a potential of high return also. So one tip is that once you invest in any asset class, you should monitor your investment on a regular basis and keep yourself updated about various market happenings to take corrective action. Always check the potential risk and do proper due diligence when promised returns are usually high. Chapter 4: Saving Related Products. In this chapter, we will discuss about the various savings related products available to the public. These include deposit schemes offered by the banks, government deposit schemes, public deposits issued by the companies, etc. Why to keep money in banks? Drawbacks of keeping cash at home are mentioned as below. It is unsafe, it has lots of growth opportunities and no or low credit eligibility. Money can be stolen or lost due to natural calamities, and it also has a loss of interest income. And if it is deposited in banks, it creates eligibility for taking loans. Therefore, it is beneficial to keep money in banks rather than at home in cash. Banking. Commercial banks are regulated financial institutions as they deal with public money and trust. Commercial banks and in equity in India are regulated by Reserve Bank of India. Banks are required to go through mandatory inspection and audits at various intervals and are also audited by the Reserve Bank of India every year. Bank deposits are comparatively lower risk investment. Banks offer various types of deposit depending on the needs of the customer. Bank deposits are preferred more for their liquidity and safety than for the returns. It is also possible to get loans from banks against fixed deposit up to 75 to 90% of the deposit amount. Central government deposit insurance schemes ensures that all the deposits are insured by government up to a limit of 5 lakh rupees per customer in that particular bank. So even in case of failure of a bank, depositors are assured that the government will step in and return up to 5 lakhs of their investment in that bank. For complete details on the scheme, one can refer the website of Reserve Bank of India from time to time. Account opening process. Know your client or KYC loans. For opening any type of bank account, customers need to undergo the process of complying with the KYC norms. KYC stands for Know Your Customer. The objective of KYC is to enable banks to know and understand their customers better and help them manage their risk prudently. The KYC documents generally accepted by banks are photograph, document for proof of identity, that is copy of PAN card, Aadhaar card, etc. And document for proof of address, that is copy of electricity bill, driving license, passport or Aadhaar card, etc. Uh, Types of bank accounts, uh, types of bank deposit and their key features. The first one is savings account. It has low interest, however highly liquid. Facilitates payment mechanism through ATMs, no tax deducted at source on interest on savings bank account balance, but taxable in the hands of the depositor. Account can be opened in single name or joint names. In the case of joint account, the operation of the account can be done by any one account holder or jointly. Minors of any age can also open a savings bank account through their natural or legally appointed guardian. Minors above age of 10 years can also avail additional facilities, banking facilities like internet banking, ATM debit card, or checkbook facilities, etc. Basic savings bank deposit account. So it is to introduce to promote financial inclusion. Zero balance savings account without any requirement of an initial deposit can be opened for individuals and also minors through their guardian. Relaxed conditions for number of deposits or withdrawals in a month. ATM card and passbooks are issued free of charge, and the account holders are not eligible for opening any other savings bank deposit account in that bank. Involves placing funds. Uh, Next one is fixed deposit account. It involves placing funds with a bank for a fixed term at a certain interest rate. Interest accrued or earned on FD is subject to tax deducted at source beyond a stipulated amount. Senior citizens may get extra benefits on the interest rate. Tenure and rate of interest. on FDs varies from bank to bank. Recurring deposit amount. A fixed amount is deposited at monthly intervals for a predetermined term. Earns higher interest than savings bank account. TDS applicable on interest accrued or earned beyond a stipulated amount. Senior citizens may get extra benefits on the interest rate. Tenure and rate of interest on RDs varies from bank to bank. A special bank term deposit scheme. Tax saving schemes available with banks. Relief under Section 80C of Income Tax Act 1961. Term deposit with 5 years locking period. No premature withdrawal or loan is allowed. Next one is digital banking. In the modern era, transactions include payments, fund transfers, and buying goods. All take place on digital platforms such as mobile phones. Customers can perform transactions from any place. The various digital modes of transferring funds are as follows: mode of transfer and key features. There are four mode of transfer are here. First one is NEFT, then we have RTGS, third one is IMPS, then last one is UPI. So in NEFT, the full form is National Electronic Fund Transfer. It is to transfer of funds from one bank account to another. No restrictions on the minimum or maximum amount for transfer. Transfer is done using beneficiaries, account number, and IFSC code. IFSC full form is Indian Financial System Code. A unique code is assigned to each bank branch. The charges for transfer may differ from bank to bank. Transfer of funds can be used any time of the day, and it takes few hours to get credited in the beneficiary account. RTGS. RTGS full form is real-time gross settlement. It is to transfer of funds from one bank account to a different account from the bank. This is used to make high-value transactions. Transfer is done using beneficiary account number and IFSC code, that is Indian Financial System Code, and charges for transfer may differ from bank to bank. Transfer of funds can be initiated during the specified period on working day and is completed instantly on a real-time basis. IMPS is Immediate Payment Service. It is to transfer of funds from one bank account to another, facilitating facilitating instant fund transfer. For fund transfer through internet banking, beneficiaries account number and IFSC code are needed. For fund transfer through mobile banking, beneficiaries MMID, that is mobile money identifier, is a 7-digit issued by the bank to the customer is needed. Unified Payment Interface, that is UPI. So it has instant transfer of funds through any smartphone using VPA, that is virtual payment address. It has 24/7 fund transfer facility on a real-time basis. One needs to download the UPI-enabled bank app and log in using bank details. Uh, New categories of banks and business correspondents. RBI has introduced certain new categories of banks and business correspondents whose key features are detailed as below. First one is title payment bank. So payment bank is provides savings account and current account facilities. It can accept demand deposit but not recurring or fixed deposit. It can issue ATM or debit card but not credit card. It cannot give loan or advances. It can offer payment and remittance service through various channels. Second one is small finance bank. Small finance bank provides features like taking small deposits and disbursing small amount loans. Instrument to save funds primarily to unserved and undeserved sections of the population. It can also extend loans of a small amount to small business units, micro and small enterprises, small and marginal farmers, and entities in the unorganized sectors. Third one is business correspondent. It is a representative of a bank who goes to customers, usually in remote locations or villages, to help them with their banking needs and transactions. Can provide services like opening of bank accounts, deposits, transfer of funds, collection of loan deposit, dispersal of small value credit, collection of payment and fees, etc. Next one is digital payments, do's and don'ts. What we should do about the digital payment and what we should not. So let's start with the do's. Use a password for your computer, laptop and mobile so that no one else can access your system without your consent. Change your passwords and security settings regularly. Always visit your bank's secure internet banking website directly. Avoid using internet banking on unsecured Wi-Fi networks such as railway stations, airports, cyber cafes, etc. Log out of your internet banking mobile banking application immediately after you have completed your transaction and, up, and before closing the window. Update the mobile banking app as and when a new version or upgrade is released. Also update your phone with the latest security systems and software. If you suspect unauthorized transactions in your account, report it to your bank immediately or at least within 3 working days so that your complaint or grievance is addressed in your favor. What are the don'ts about digital payments? Never save your mobile banking login ID and password on the same phone. Either memorize it or write it down somewhere else that is safe and not accessible to anyone. Never leave your handset unattended and log into a mobile banking app or internet banking account or while carrying out any financial transaction. Never ignore your account balance statements and transaction history. Don't keep your PC or laptop lying around when you can use or trust a stranger to use it. Never download any apps from untrustworthy and unreliable sources. Next point is what is credit card and debit card. So credit card gives the card holder the benefit of availing credit facility for a certain period of time. For example, making payments without having immediate money in hand in the form of credit card transactions. Debit card, on the other hand, is a card issued to a bank account holder for withdrawing money at ATMs from his account, as well as to make payment at point of sale. All the merchant establishments accept debit cards in settlements or transactions. Both credit card and debit card can be used for withdrawal of cash from ATMs as well as for digital transactions. What is the comparison between a credit card and debit card? It is listed as below. So in credit card, the source is lending bank provides the credit facility. Where in debit card, the source of fund is it is linked to one's own savings or current account maintained with the same bank. Uh, while using the credit card, if outstanding amount is not paid, then interest is levied. But in debit card, it is not applicable because the amount is getting directly debited from the person's account. Credit history relevant for issuing a credit card, but in debit card, it is not relevant for issuance of the debit card. Relationship with the issuer. No compulsion to have account with issuing bank. So if someone wants to have credit card of X bank, then they are not required to open a bank account with them. But in debit card case, having an account with the issuing bank is prerequisite. Things to keep in mind while transacting through ATM card. Change the PIN immediately when the card is received from the bank. Right? Don't write down your PIN number anywhere. Memorize it. Don't disclose your PIN number to any third person. Preferably use an ATM within bank premises or premises which are manned 24/7 by a security team. Use it personally. Bank has no liability in case the ATM card has been handed over for transaction to any other person except the account holder. While using the online transaction, use the virtual keyboard. Register yourself with bank for getting SMS alert on transactions. However, banks may charge customers for providing SMS or email alerts related to their bank accounts. Change your PIN numbers as often as convenient. If the card is lost, immediately inform the bank. Do not allow anyone to access or use your customer liability for unauthorized banking transactions. RBI has specified that a customer has no liability when an authorized transaction happens on account of fraud, contributory negligence, or deficiency on part of the bank. Similarly, even when neither the customer nor the bank is at fault, but the problem lies elsewhere in the system, the customer does not have any liability provided he or she notifies the bank of the unauthorized or illegal operation within 3 days of receiving an alert from the bank, and the bank shall credit the amount involved in such transaction to the account, customer's account within a specified time period. However, in cases where such fraud takes place on account of negligence of the customer, the entire loss until the date of reporting the unlawful transaction will be borne by the customer. RBI has emphasized banks that they need to send SMS and email alerts to the customers immediately after a transaction is carried out in their account. They have been instructed to ensure that such messages are enabled to carry the customer's reply to, so that a customer can report any such fraud immediately. Reserve Bank of India. RBI is the Central Bank of India. It was established on 1st of April 1935 under the Reserve Bank of India Act. The Reserve Bank of India uses monetary policy to create financial stability in India. It is charged with regulating the country's currency and credit systems. The main purpose of RBI is to conduct consolidated supervision of the financial sector in India, which is made up of commercial banks, financial institutions, and non-banking finance companies. It formulates, implements, and monitors India's monetary policy. The central bank's management objective is to maintain price stability, ensure that credit is flowing to productive economic sectors. RBI acts as a regulator and supervisor of the overall banking system, and it is also the banker of the government of India. RBI is also the lender of the last resort for or commercial banks. Grievance redressal. For redressal of any grievance regarding banking industry products schemes, please refer to Chapter 12 of this booklet. So, government schemes in banking industry. Okay. So, next one is Chapter 5, that is investment in securities market. So, before investing in securities, it is better to understand the market and be fully aware of the risk involved. Be aware of your capacity to handle risk and invest accordingly. Generally, you can evaluate your potential investment analyzing 7 key risks as mentioned below. So, what are these 7 risks? First one is systematic risk, second one is unsystematic risk, third one is inflation risk, fourth one is liquidity risk, fifth one is business risk, sixth one is volatility risk, seventh one is currency risk. First one is market risk or systematic risk. An investor may experience losses due to factors affecting the overall performance of financial markets and macroeconomic factors. Stock market bubbles and crashes are good examples of heightened market risk. Unsystematic risk. Unsystematic risk can be described as the uncertainty inherent in a particular company or industry. Examples of unsystematic risk include a new competitor in the marketplace with the potential to take significant market share from the company an investor is invested in. A regulatory change such as one that could drive down company sales, a shift in management, a product recall, etc. Third one is inflation risk. Inflation risk, also called as purchasing power risk. It is the chance that the cash flows from an investment wouldn't be worth as much in the future as they are today because of a decline in purchasing power due to inflation. Fourth one is liquidity risk. Liquidity risk arises when an investment cannot be bought or sold or converted into cash quickly enough to prevent or minimize a loss due to meet any immediate expenses. You can minimize this risk to a great extent by diversifying your investments. Fifth one is business risk. It refers to the risk that a business may stop its operations due to any unfavorable market or financial situations. Sixth one is volatility risk. It refers to the risk when the stock prices of a company may fluctuate, even when those companies are not in danger of failing. Seventh and last risk is currency risk. So currency risk arises when there is a possibility of losing money due to unfavorable movements in exchange rate. It may happen from changing price of one currency in relation to the other, and investors who have assets across nation borders are exposed to this risk. How to mitigate this risk? So the investors can try to mitigate the risk by different means. Asset allocation is one strategy through which an investor can benefit from the diversification of their investment into various sectors and companies to mitigate risk. Volatility risk can be managed by investing through systematic investment plan of mutual funds or buying equities directly from the market in smaller lots over a period of time. A good understanding of the fundamentals of a company can help one make an appropriate judgment about the health of a company. Of course, investors should ignore the rumors and unsolicited messages for investing in securities market. Investment in securities market are done through primary market as well as secondary market. The difference between primary market and the secondary market is that in the primary market, investors are allotted securities directly by the company, while in the secondary market, investors buy securities from the existing investors through their stock brokers. Investment in securities market are subject to taxation, which includes short-term and long-term tax on capital gains as well as dividend payments. What are the prerequisites to invest in securities? In order to invest in equity shares, an investor should have three accounts: saving account, trading account, and demat account. So, saving account, saving bank account with a commercial bank, trading account with a SEBI registered stockbroker of a recognized stock exchange to buy or sell securities on the stock exchange, demat account with a SEBI recognized depository participant of a depository for holding securities in dematerialized or electronic form. The demat account can be opened with a depository participant of any of the depository. Nation Securities Depository Limited and Central Depository Services India Limited are two SEBI registered depositories in India. The list of SEBI registered stockbrokers and SEBI registered stockbrokers and depository participants may be obtained from SEBI's official website or from the websites of the respective stock exchange and depositories. Primary market. When a company publicly issues new stocks and bonds for the first time, it does so in the primary market. In many cases, this takes the form of an initial public offer SEBI examines the prospectus issued to the public for subscription of shares to see that it meets with the requirements of the SEBI regulations. Companies issuing securities by the primary market hire merchant bankers who, on behalf of the company, prepare the prospectus and ensure related compliance. For the issue of shares, this finalization of allotment process, listing of shares in the stock exchange, etc. Application supported by blocked amount, that is ASBA for shares. An investor can now apply for shares in the primary market through ASBA in public issues of 1st of May 2010. All the investors can apply through ASBA. ASBA is an application by an investor containing an authorization to the bank to block the application money in his or her bank account for subscribing to an issue. Blocked amount continues to earn interest if the investor is applying through ASBA. His application money shall be debited from the bank account only. If his or her application is selected for allotment, after the basis of allotment is finalized, the investor need not to have the need not to have to bother about refunds as money to the extent required for allotment of securities is deducted from the bank account, and in case the securities are not allotted to the investor, then the blocked amount in his or her bank account is released and made available to use. So this was the financial education part 1, and in next video we will go through the part 2. So that's it for now, and we'll see you in part 2 of this video.